So welcome everyone. For those of you who don't know me, my name is Michael Blakely and I'm the founder of the Entrepreneurs Collective, and we are the host for this evening, hosting a workshop with 7 Legal who will be helping you guys to learn all about fundraising and negotiating a term sheet. Just a little bit first about Entrepreneurs Collective so that you can understand a little bit about what we do. So our mission statement is founders helping founders. And I know a little bit about this myself because I, like many of you in this call, I'm a founder. So my background is I was a lawyer working in competition law, international sanctions, data protection, a number of sort of blue chip corporates. And I was also working at an accelerator in Stockholm a few years ago, where I caught the startup bug and decided to go a little bit rogue, and I built a dating app called Clicked. So from international sanctions to dating was a bit of a steep learning curve. I made many mistakes along the way. I struggled with a lot of things as a first-time founder, the fear of failure, the lack of people to talk to. I struggled to find investment. I got some bad referrals, some really bad developers. And when I tried to grapple with some of these issues, I went out into the market in London. I really struggled to find good events and meet good quality founders where I could try and get some help or share my problems with. But being entrepreneurial by nature, I decided to set up my own community, given that I couldn't find a good one out there. And that's where the Entrepreneurs Collective has come from. In terms of what we do, well, actually, the main emphasis on the collective is, as I said, founders helping founders, and we do this in a number of ways. So we host events and workshops like the one that you're attending this evening. We have dozens of amazing mentors who are specialists in their areas, who have agreed to give up some of their time to help founders who are part of our network. We have regular pitch competitions for those of you who are fundraising. Our last pitch competition, we had over 100 attendees, a number of VCs, as well as private individual investors. We do other things like help founders with tech reviews and give feedback, and offer access to credits such as AWS, Stripe, Google, and all these things to try and bring your costs down. But less about the Entrepreneurs Collective, but let's move on to what is the real topic for today, which is fundraising. At this point, I'd like to introduce Bill Cogan, a long-term associate of mine and a supporter of the Entrepreneurs Collective, who has excellent experience, having completed dozens, or if not hundreds, of fundraising transactions in the startup space. I know many of the companies that have worked with him and completed successfully their fundraising. So I'm fully confident that you are listening to exactly the right person to help you, guide you through this process. So Bill, could we get your slides up?
Excellent, so we'll do.
Yeah, and welcome to the call, Bill. Let's see. Before I move on to Bill, just a couple of little admin points. As Bill is going through, please do feel free to drop any questions into the chat. These materials we will be recording. We're recording this session, so we will share this and the materials after the call by mailing list. And there will also be Bill's contact details so that you can contact him if you have any follow-up questions. Any questions that you put into the chat, Bill may answer as he goes through, or time permitting, answer at the end. But without further ado, I will hand you over to Bill. Thanks.
Well, Mike, thanks so much for that. Yeah, and thanks very much everyone for joining. We're delighted to be a sponsor of EC. I actually came to the community, as Mike might have mentioned, as a founder myself, was attending the events, and there actually became the only event I actually attend in London in the startup scene. It's a great network to be part of, and the ethos is very much helping each other through. So yeah, 100%, it's great to be here, and very proud to be sponsors. As we said, a quick agenda for the evening. First of all, just do a quick bit of intro about us, Seven Legal. We'll give you a quick overview of the funding options in the UK, and then after that, we'll walk through a term sheet. The focus really on the term sheet section is to give you an insight as to what's being asked from both sides of the table, from the investor, what protections they're looking for, and from the company side, what's market and what you guys could be pushing for or should be asking for reasonably in each instance. So quick note about who we are. There's a team of 10 of us. We're actually only up and running about 7 months. Now we do corporate commercial employment, and really the business model is quite simple. We've effectively taken city lawyers, taken them out of a large cost base and put it into a very lean model. So we can work with startups, scale-ups profitably. So we're highly interested and motivated to work with businesses. And we do that in a few ways. We do it by fixed fees, retainers, and just having grown-up conversations around budgets. And our focus really is on long-term relationships, both across our team and our clients. So we're here for you as you grow and scale. And how do we do that? How do we support you guys? Funding rounds and exits, in terms of putting money in your pockets, into the company's pockets. That's the bit that we love doing. We also help, once you've got a budget, to protect your assets in the form of commercial agreements. And finally, then when you're hiring, firing sometimes, and incentivizing your staff. That's the core remit of our support. So moving on swiftly then. So in terms of the UK investment overview, I know that there's quite a big audience here, so I thought I'd do a quick overview of the types of investment that are available, what we're seeing in the market, and just a few slides around investments generally. So here you'd see kind of a typical startup journey from start to finish. Starting out with friends and family rounds. This is from the UK Business Angels Association. They've listed credit cards as a source of funding. We would not endorse that as any type of sensible financial information. But really, initially, it is looking to particularly friends and family, really, and your own funding to get a business off the ground. Moving in then to business angels. And crowdfunding typically would be the kind of next level up. And then after that, you're moving into more institutional funding, which is typically where we come in, is negotiating either large angel rounds or when you've got a sophisticated investor on the other side, and you need some assistance. As you're expanding, then obviously kind of VC and PE style investment comes through as companies develop. And then eventually you are looking at as an exit, either IPO, an MBO, or a trade sale will be the typical life cycle and avenues for funding in the UK. In terms of the I guess, biggest piece to know about the UK investment scheme, it is the Seed and Enterprise Investment Scheme. These are tax breaks for investors, starting with 150k, and then in SEIS, and then onwards for EIS. This is being called by a very well-known VC investor the most innovative thing to come out of the UK in the last 20 years, including all technology, including everything else. It's actually this tax break. It's absolutely huge for the early stage investment market. It's probably the reason why we're all here tonight, in either directly or indirectly. So getting your company ready to be EIS or SEIS investable is crucial really at the early stage. And you can see that by the amounts that have invested year on year through these schemes. In terms of the UK generally and VC investment, you couldn't really be in a better country, or if you're in London, probably a better city outside the valley if you are planning on raising you are raising VC investment. As you can see, the UK alone raises more investment than Germany and France combined, and about 1/3 of total investment in 2019. And this trend is not really predicted to change in the incoming years. So if you are looking to be backed by VC or corporate venture capital or institutional money generally, the UK is a great place to be generally. So what does the market look like post-COVID? I guess from our own experience, what we saw, as I'm sure with everyone's experience, was when COVID hit, there was a lot of panic. People were figuring out what to do with their businesses to survive, and so on. What we saw amongst our client base was there was a mixed reaction. Some had runway for 12 or 18 months and weren't really affected. Other businesses went out to raise from their existing shareholders and were able to secure funding that way. And then probably, from June, July onwards of this year, we started seeing things moving again from an investor perspective. We saw term sheets landing and funding rounds carrying on. So as with anything, and when the entire economy is affected like this, there are going to be sectors that are winners and losers. From speaking with clients who are in sectors that are now in demand, healthcare, edtech, last mile delivery, they are saying that, look, there's a lot of capital out there to get your hands on, particularly given that there's potentially less noise now with certain sectors affected. Overall, that's kind of been our experience, and just kind of reflecting on speaking with our client base. Overall, I think European seed stage funding is down at the early stage, but that also could be down to just a lag in the data, because seed stage generally isn't reported on as closely as later stage funding. But overall, European venture stage was up on last year, both quarter over quarter and on last year. So, the economies around the world are still printing money. There is a lot of capital out there to deploy. You speak with a lot of investors saying, look, we've got plenty of dry powder to get out by the end of the year. So, we're fairly optimistic for, both the rest of the year and into next year as well, particularly in technology, as we've seen in the size of IPOs, and that technology is certainly a sector that is still attracting capital. So as a quick overview, both in terms of funding options and also just the funding market in general. In terms of our next section, like I said, we'll be walking through a term sheet. And just for anyone who doesn't know what a term sheet is a non-binding document which summarizes the term deals for a funding round. There's an excellent book on this topic called Venture Deals. Highly recommend it to anyone who's considering raising at any point in their career. It's excellent. It really is the kind of go-to Bible if you want to learn about funding rounds. It is US centered. It's come out of a couple of really prominent VCs out of the Valley. But having looked at it from a UK perspective, it really does give you excellent insights. And actually, if you've read the book, you probably recognize a lot of things in this presentation from there. The way to approach term sheets and the lens, if you want to actually look at, is through three different lenses. One, you break down the terms by the economic terms of the deal, the control terms, i.e. what controls are investors going to hold post-investment, and then administrative terms. And while you're negotiating, you need to be aware of these terms so that really the meat of the deal is in the economic terms and the control terms. So give some consideration to administrative terms, but really be aware that the first two are, where the action is and where you should be concentrating on for the negotiation. Don't be distracted by administrative terms that, may or may not have a large impact, which should have a relatively small impact, as we'll see. So starting off on the economic terms, typically funding rounds will be either debt or equity. That is what you'd be looking at in terms of instruments. The share types, if it is an equity deal, you're typically looking at two types of shares, preferred or ordinary. Ordinary shares are those that you'll incorporate, that you'll be issued on incorporation of the company, and typically are, one share, one vote, and fairly standard terms. In terms of preferred shares, these are typically only introduced at the point an institutional investor is coming on board. So you'd probably see these at more late seed or Series A levels, where you're introducing, preferential terms and a lot more investor protections, which we'll come on to very shortly. One thing to note on with preferred versus ordinary, if your investors are claiming SEIS or EIS, they can only be only issued ordinary shares. So a lot of the investor protections that we'll see later on would not typically apply at earlier rounds for kind of angel investors. And the reason being there that the investor reliefs are so good under SEIS and EIS, the government has said, look, from an investor perspective, you're already hedged with these tax reliefs, so you need to take some risk, and the company shouldn't be taking all the risk at that point. So it's very company and founder friendly move from the government, which is great. And like I said, SEIS and EIS have been a huge boon to this entire sector, and are really the envy of Europe as well. So that's the shares and what you typically see on a kind of more a traditional equity funding round. The other methodology is debt or convertible debt. These originally developed again out of the Valley with convertible loan notes. Originally were actually to reduce lawyer fees. That was the rationale behind them, and it was viewed as, okay, this is a quick mechanism to get cash into a business without having to negotiate a full funding round, both through the long form investment documentation plus the valuation conversation. So it allowed investors to get money in and kick a lot of the conversations down the road as to when an actual later funding round comes on board and the kind of worth of the company has shaken out, and everyone can figure out a fair valuation for that. So if anyone is familiar with Y Combinator have taken convertible loan notes, made them more streamlined and call them safe notes. But what they are is a loan instrument which can be converted at a later date into equity, typically a later funding round. And as part of that, as part of the reward for an investor putting in that early cash, a negotiation around a discount to the valuation of the converting round, plus potentially a coupon as well, will be negotiated. One thing to remember about the UK is that no debt instruments can be used for SEIS or EIS relief. So if an investor is investing via debt, they don't get the tax relief. So it's quite unusual, actually. Well, sorry, it's unusual for UK investors to be using convertible loan notes if they're taxpayers in the UK, because most people want to write off the tax. So in the UK, oftentimes an advanced subscription agreement would be used, which is just very simply, here's cash, giving the equity later in exchange for a discount, either converting at the next round or with a long stop date of within 6 months of issuance. The last type of instrument that we're talking about here, you'd see are warrants. There would typically be issued, they're effectively options. They give the holder of the warrant an ability to exercise the warrants at a later date for shares. So you might see these as sweeteners for bank finance, or oftentimes introducers when arranging finance for an equity round may say, look, we'll take a portion of our reward in terms of fees will be in warrants that we can exercise at a later date. Something to be aware of, obviously there's more liquidation, so when you're looking at your cap table, keep an eye on your warrants and your convertibles when entering into a round. So valuation is the next heavily negotiated point for a round. Obviously, this directly impacts dilution for any company. So, from a company perspective, typically you're trying to increase your valuation. Investors are trying to push that down in a lot of instances, just so that they're getting more the more the company for their money. What are the factors? At the early stage, it's more difficult. You typically look at what stage is the company. Has the company been able to rustle up some competition amongst the different sources of funding, so they can kind of play a bit of a negotiation? Who are the team? Are these experienced entrepreneurs? Have they built, scaled, and sold businesses previously? If so, they'd probably be able to demand a slightly higher valuation, or a much higher valuation in some cases. Is the company revenue generating? Is there a solid business plan in place? Is it profitable? And also then the economic climate. Is there a lot of capital generally available? Is it a good time to invest? Is a certain sector hot? These all play in. There are more scientific methodologies of doing this. Typically kind of benchmarking against other companies within your sector or market that have raised recently. And there are more scientific methodologies, which as a lawyer I won't get into. I'll leave that to my corporate finance colleagues. So that's generally the kind of cut and thrust of entering into valuation discussions. The purchase price for your shares is effectively, once you get your pre-money valuation, you divide that by the total, the fully diluted share capital, which is the total shares in issue plus any convertibles as well. So that would be things like convertible loan notes, advanced subscription agreements, or any warrants as well, plus your option pool. So that would be the definition of fully diluted. The post-money valuation, again, you'd hear a lot about, will be the pre-money valuation plus the amount that you've raised as part of the round. What you do see sometimes is a request for staggered financing from an investor perspective, and that's okay. We'll go out and the company's raising 3 million. Investor will come along and say, yeah, you can have 3 million, assuming that, but we'll give it to you in several tranches. There's a few ways to think about this. From the investor perspective, it's great because they're not fully cash out, and they're still holding on to the cash, and they can set parameters by which they will follow on with that funding. From the company perspective, this can be problematic, mainly because if you don't hit those KPIs, you can find yourself in a very difficult situation, because typically what happens, or what can happen, is that when negotiating this, the KPIs will be relatively vague if they're not done correctly. So really what you want here is very, very clear and easily achievable from the company side KPIs. So you want to be able to hit that KPI and get the check immediately. The reason being that if you aren't hitting those KPIs, or you're coming very close to not hitting those KPIs, it's going to be very difficult to go out and raise funding elsewhere, because effectively, one, you're head down trying to hit these KPIs. Two, you're going to market with a negative story, because you're saying, look, our current investors aren't going to come in, we've missed our targets, will you back us? Not a great negotiating position, and also you wouldn't have any leverage with your existing investors if they decide not to be cooperative. So from the company perspective, it's not ideal. The way we'd try to recommend negotiating that is, one, as I said, very easily achievable KPIs plus very clearly defined KPIs. So there's no argument about hitting them, and they're easy to achieve ideally. The second thing would be approaching the investors and saying, okay, well, look, if we agree to this, effectively you're hedging your bet here by not being cash out, plus you're getting a more valuable company every time we hit these KPIs. So to manage risk and reward, we're happy to do that, but let's have a different valuation for each KPI achieved. And then that way, from you're balancing both sides, companies getting, founders getting less dilution, investors are getting a more de-risked investment. Again, some investors will go for it, some won't. And coming back to kind of competition for sources of funding at the start, that'll be the ideal way to do it. So another factor that you may not consider, or is not oftentimes considered when looking at valuation, is how the option pool effectively affects valuation. So the from the company or founder side, you really want to make sure that the option pool is ideally limited as much as possible, because effectively that dilution is all being taken by the founders in the first couple of rounds. From the investor side, typically typically an investor will say, look, we need a option pool in place. So it comes down to what the size of that option pool is. We'd see anything kind of 0 to 15, 20 at the very large end. To push that conversation the way you want to is going in with a very clear hiring plan and saying, look, okay, if the investment is coming in for 12 or 18 months runway, these are the hires we're making over the next 12 or 18 months. This is the amount of equity, if any, we're giving. So we don't need a huge option pool. We'll sort out the option pool at a later date. The later date being when the investors are already on the cap table, and so the dilution is spread across, which is a reasonable position to take, given that from the option pool, everyone is going to get the upside of having highly engaged employees driving forward, hitting milestones and increased valuations. So it's only right to share that dilution across both. But make sure you're going into those conversations with an option budget, your hiring plan, and a good rationale for the size of option pool that you're going for. The next thing that gets negotiated would be around preemption rights. Preemption rights are the requirement for giving shareholders the ability to participate in subsequent rounds, and also in any transfer of shares subsequently. So on the issuance, a lot of this becomes extremely important for institutional investors when they want to follow on in subsequent rounds. So at the very minimum, investors will be looking for a pro rata entitlement at the next round, i.e. if they've taken 20%, if they have a 20% shareholding in the company post-round, they'll be looking for at least 20% entitlement at the next round. This will depend on your investor, if they do generally follow on, if they've got the cash to do so, or the appetite down the road. One thing that is typically positioned is the shareholders will will take up the allocation. So in effect, what happens there is that because the founding team typically don't have capital to deploy into a subsequent round, that leaves the entire allocation up to the control of the remaining shareholders, which generally means the institutional shareholders in a round. The way to counter that is to revert the allocation to the board post pro rata, i.e. what the negotiating position is one, you can have your pro rata entitlement, fantastic, it's great to have you guys on board. After that, the board or founding team want the ability to choose who comes into the round next, at the next round. And just having that control is a good idea. It allows the founding team or the existing shareholders to excuse me, to have control over who's coming in around and who's going to be eventually owning your business. Same thing on a sale. If anyone is going through a preemption process, in that at some point either a shareholder or a member of the founding team want to sell their shares, typically there's a preemption right for the rest of the shareholders to buy a pro rata entitlement. I guess as a general note on this, it is a good idea in that you don't want a closely held company like an early stage business to be widely transferred, or a competitor, for example, buy shares. That being said, overall the UK and European Early technology market is nowhere near as liquid as, say, in the US. It's just not as mature ecosystem, and the size of the market means that there's not a whole lot of liquidity. Certainly until you kind of get to the later stages where you get secondary funds or maybe private individuals who may want to buy it, but just something to bear in mind as you're going through. So then we're coming on to kind of more the complex or relatively complex investor protections, which are not available to SCIS or EIS investors. So again, these would only really be seen once you've got an institutional investor or maybe a sophisticated non-UK angel investor come on board. So, maybe for the first couple of rounds, you would see this. At the point you're at your kind of late seed, Series A, these type of protections are what you're going to see, and nearly anyone who's putting a term sheet in front of you are going to ask for these. So liquidation preference is the first one, and that's the way you think about that is who's getting their money out first at the point of an exit, and that comes in two ways. These rights would only be attached to the preference shares. And the way it works is effectively two ways. One, I think the example here is a pretty good one, that will take a 1x liquidation preference on of £1 million investment at 4 million valuation. So after that round, you'd have an investor holding 20% of the company post round. At the point of an exit, then they could either be participating or non-participating. So participating would mean that money comes out first to the investor. So of a 5 million pot, 1 million comes out, first of all, and then there's a double dip in that the investors or shareholders having the liquidation preference also would get their percentage entitlement of the round. So that goes from a £1 million return to a £1.8 million return, because they double dip, take cash out, and then you get your percentage as well. The non-participating then participating liquidation preference is an either-or mechanism. So you either get your £1 million back, or you take your shareholding percentage, and typically you're converted into ordinary shares at that point as an investor. The non-participating is market standard. Well, sorry, it's more or less market standard. 1x non-participating would be relatively market standard, particularly at the early stage. Up to kind of Series A, Series B, that's typically what you'd see. If you see investors at an early stage coming in and saying we want either a participating liquidation preference or a multiple liquidation preference, we'd say that's off market. We had that for a client recently at the beginning of the year. They got a term sheet in saying that, look, it was for a fairly chunky round. The liquidation preference was in there as a 1x participating. We advised them that, look, this is off market. We called around a bunch of other founders that we know and to check as well. The general consensus was no. So they actually pushed back and just left the term sheet on the table, didn't go forward with that. Fortunately, they had drummed up a bit of competitive tension and had already spoken with a few other VCs, so completed the round. But again, if you've got the luxury of being able to do that, it's a great thing. If not, sometimes you just have to take the money. So that's liquidation preferences. And as the note says here, at higher valuations, this makes less and less of an impact. Obviously, £1 million out of a £5 million exit or a £3 million exit is a lot of cash in relation to how much is being paid out across the shareholder base. At a £100 million exit, £1 million coming out and the rest being spread around becomes less of an issue. So anti-dilution is protection for investors in the event of a down round. And a down round is where a company raises at a valuation lower than the previous valuation. There's a few ways of doing this, and we'll start with the most draconian, and one that if you see on a term sheet, you're dealing with a bit of a shark of an investor. A full ratchet that would be literally repricing the entire previous round based on the new round. And I'll explain why that's so damaging to typically the founders or the early stage investors, is that if you come in for a down round, you're going to be taking dilution from the incoming money into this new down round, but plus your previous round gets repriced. So you're taking additional dilution from the previous round as well. So it becomes a double whammy, and a lot of instances, either founders or early stage investors will get wiped out with that. The more market standard way is a weighted average. So effectively what you look at is the valuations between the two rounds plus how much is being raised between the two rounds. And then the formula effectively levels that out in a more equitable and fair manner. One way of negotiating this is insisting that a pay-to-play for this mechanism is required, i.e. to your investors, you would say, great, look, we'll give you this protection, but in order to avail of that protection, you also need to invest in the subsequent round. The rationale being there that, well, look, if something's happened to the company, if something's gone wrong, we haven't hit our targets, we're going out, it's a tougher funding environment. We want our existing investors coming out with us to bat. It's a good signal to the market. If you guys aren't doing that, then you shouldn't be getting the protection that's afforded by the anti-dilution mechanisms, because in effect you could actually be causing a lower valuation by not participating. So again, something to negotiate with investors. And also, a lot of times where this does shake out as well is it's a conversation between the incoming money and the existing institution money. Oftentimes you'll have investors saying, look, we're happy to invest, but not if the founding team is being wiped out or heavily diluted, because in effect you'd have a potentially demotivated management team that aren't really incentivized for success. So oftentimes the kind of negotiations around the cap table will be multilateral. Will be the founding team, existing investors, new investors, and how best to play that between. That being said, I wouldn't rely on those conversations. You're best off having as much protections from your side as possible at the outset. So tag and drag then. We are starting off with drag along. So this is the ability for a majority, or typically kind of a super majority, to force a sale on the remaining shareholders. So this will be, you'd often see 75% here. Oftentimes you might even see 50 as rounds go on. And the rationale here being that the majority of shareholders shouldn't be held potentially hostage by a small minority of shareholders. So oftentimes, I guess as a general principle, every round that we go into, and every round we've, as Michael mentioned, we've kind of been through a few hundred at this stage. The kind of two main focuses that I try to keep front of mind is, one, as a company, can you go and raise more money? Do you have the ability to raise more capital? And two, at some point in the future, as a founding team or as an existing shareholder base, do you have the ability to exit? Because they are two, well, first is lifeblood of the company in a lot of fast scaling technology companies. And the second is, when you're getting cash yourself, so you kind of want to see that payday at some stage. So bearing that in mind, the preemption rights and the control over being able to issue more money becomes very important. And the second part is the drag along, because that's the ability to force a sale effectively. A lot of investors want to be part of that dragging majority because they want control over the exit, and the exit is oftentimes a return of capital, obviously, to investors. Where we like to position this is that at some point, the founding team or the existing shareholder base should get the ability to exit back. I.e., so if a fund is coming in at a 10 or 50 million pound valuation, what we say is, okay, what's your typical exit scenario? Is it a 5x on your money? Is it a 10x? And try to negotiate that. Okay, if the company gets to a 75 million valuation, 100 million valuation, at that point, the founding team should have the power to say, yes, we want to sell. Again, it also you also get a bit of inside knowledge into what the fund are looking at, where they see as a valuation of the business that it can go, and it just aligns everyone to saying, okay, look, we've got a bright line rule. We may not sell at that figure, but we want the ability to have that conversation and the decision to be back in our control. Again, want to negotiate. For the majority, I would say we kind of get those points in a lot, so it's definitely something worth considering. So at an early stage as well, from a founder perspective, you may want to negotiate that you can't be dragged yourself as founders. That really comes at later stages where the majority of the shareholder base is not in the founding team's hands. So you want to balance both of those. Tag along then is the inverse protection of that. So it's the inverse protection for the minorities, and what this allows is that the company can't be sold. Say if the founding team holds 55%, they decide to exit. What this tag along right gives the minority is say, hey, you can't sell your shares without us being part of that sale, and it prevents, like I said, the minority of shareholders being left on the ledge. So it's the balance between the majority and minority across those two aspects. So the control provisions of the deal. These are, really where the investors will be able to exert control over the operations or the equity within the business as well. The first part that is always very heavily negotiated is around the share restrictions and vesting. And this can be approached in various different ways. Market is probably 3 to 4 years of vesting. Vesting being the ability to claw back a portion of shares in the event that a founding member or employee leaves the business or is forced to leave. So a kind of a typical example there would be, okay, a 1 year cliff with a 3 to 4 year vesting period. A cliff is a first period of time during prior to which if a team member were to leave, they'd lose everything. So if you had a 25% cliff here, you would have 12,000 shares at the end of year one vested. So a quarter of your shares would be vested, and then the shares would vest typically monthly thereafter. So I guess the way to negotiate this with investors oftentimes is, when does that 3 or 4 years start? That clock start from a founder perspective. If you've already worked in the business 2, 3, 4 years, you can also argue that, okay, well, look, I'm 2 years into a 4-year vesting schedule. So for me, I'm only putting up 50% of my shares, and I'm willing to put in 50% of these shares into a 3 to 4 year vesting schedule. And those vesting schedules will change at each round. We were literally having this conversation or negotiation with a VC this morning. The founding team there had been, with the business a long time, so they were able to negotiate quite a small portion of their shares. The rationale being, look, we've been in the business for a long time. We're not going anywhere here. We're fully invested, particularly with new capital on board. We're engaged. So it's really having that conversation with investors. And also recognizing the work that's gone in to date from the founding team side. So the veto rights or reserve matters would be, fairly substantial matters that the founding team or existing shareholder base could take without that could overrule a minority of shareholders. So, typically investors may only hold 5 to 20% of the capital. So what they're saying is, okay, at law you could pass certain resolutions that could, or take certain actions that could potentially either harm the business, harm the shareholder base, or basically screw us over. So we're going to put in a list of actions that you can't take. And, these can be very long. They can be very short at an early stage because, effectively the company's either going to go bust or it's going to go big. And these rounds are negotiated every 12 or 18 months. So depending, what you find is obviously the further you go into the funding cycle, the more complicated these get. Really, you want to view these with a lens of, like I said, can we raise more money? Can we exit? Ideally, and then it's okay, what's the operational impact of the business day to day for these certain reserve matters? When you kind of read through them, and oftentimes we sit with founders, we just explain, look, this is why this has been asked for. For example, you can't go out and enter into M&A. Makes sense if you're raising money for a fast-growing venture. The money that you're raising is typically in accordance with the business plan, which is scale your own business. Unless you're an M&A specialist, it could be a complete pothole to lose a lot of money in. So again, it's just a matter of going to, making sure that these vetoes are in place from an investor perspective, and that every management is staying in line with what's expected. And it gives investors protection because they're not in the business every day. They're not going to be alongside you. You may see them at board meetings, etc. So it's just straight up protection for them. So look at the operational impact and then make a decision on them. In terms of the board of directors, what is typical? The way we'd say, if we're acting company side, which we predominantly do, we'd always say just try to keep control of the board for as long as possible. And that can quickly change if you don't approach it in the right way from your first round almost. If you've done a big angel round, typically an investor majority will appoint one angel director, for example, to monitor the angel investment. Where we try to negotiate there is that whoever has the right to appoint a director at each round, that right would fall away at the next round. The reason being that if you do 2 or 3 rounds quite quickly, you've got 2 or 3 angel investors, maybe a couple of board observers, and all of a sudden you've got a very packed boardroom, which can become problematic both from a voting perspective, from the founding team's perspective, and also just too many voices in the room. If you're, particularly at the early stage, if there doesn't need to be that many people in the room, then try to avoid it. So investors will either look for a board seat or a board observer seat. The board observer seat, it means you can be in the room, but you're not making any board decisions. What you can obviously do when you're in the room is influence other decisions. So I'd be very cautious, again, who you're letting onto your board. Can they give you the right stage-specific advice? So a director who's really good at, your first check in the door up to, seed Series A might be amazing for you at that stage. Are they the right director, and are they going to be able to give you the right direction onwards from there? Maybe, maybe not. So I'd be, trying to keep that in as much control as possible. And I'd say that actually about all advisors as well, ourselves included. We're very good at a certain stage. You need to be handed off to a different type of advisor at a later stage then. So, through your founding journey, always keep that perspective alive and be aware to it. And, again, the last point here about minimum shareholdings, that's just making sure that be wary of any investor who's embedding their appointment rights into the documentation for the life cycle of the business, because they're going to be sitting in that board seat for a long time. And the other thing that comes around then is debate or conversations around what fees are payable for investor directors. There's different ways of approaching this. I've just seen an update. I think some of the PwC do a report quite regularly around payments to investor directors. So check that out, and I'll try to link that as well post this. The ESOP, or the employee share option plan, another area of negotiation. Again, we were looking at this this morning. Typically in the ESOP, founders are generally excluded. It's used as an incentive to attract talent. One thing I would say there again, is where we see a lot is equity being given out very quickly at an early stage, a couple of percent here, a couple of percent there. Oftentimes it's to the members of the team who may not be there in a couple of years, or a couple of months in some instances. So just make sure that your ESOP is set up right. There's vesting schedules in place, and it's only being given out to team members who you think will be there with you for the whole journey, because it becomes an administrative nightmare, and also it disincentivizes people who come into the later business who are maybe adding like serious value when they see someone else who's now not adding any value sitting on a lot of equity. So just be very, very careful of that. As we said, allocations for option pools can be anywhere 10 to 20%, 20% being very large. But frankly, you probably see more 5 to 10%, I think now is more common. And from a founder perspective, in order to avoid that dilution that we talked about earlier, making sure that you're not taking on a huge option pool, which you're taking the brunt of the dilution on, is advisable. So be aware of that. The administrative terms, as I said, you just need to be aware of these. Don't get too caught up or distracted by them. Here, what you'd be required to do, in the term sheet, is commit to reporting. This could be monthly, quarterly. What I would say there is just make sure that you can prepare it very easily, that you don't turn into a reporting function for the business, for the investors. So there, it's, make sure it's as simple as hitting a print on zero, whatever your accounting capacity is for your financials, and making sure that the updates are, very easy to achieve. Some funds, we typically would push for quarterly reporting at an early stage. As you get larger, and the funds that invest in you, they'll also be subject to reporting functions themselves. So they may actually be restricted in what they can agree to. So it may become monthly reporting. Again, just make sure that's as simple as possible. The business plan, you'll be required to commit to spending the money in accordance with the business plan. So, have that thought out. Also, typically you'll be asked to approve an annual budget and maintain spending within that budget. Again, something to be aware of. You'll be required to take out insurance, key man, director and officer insurance. Pretty easy and relatively cheap to take out now. So not particularly difficult. One thing in the GD process that will come up is has everyone who's worked on the business from start to today, have they assigned all IP into the company, including yourselves as founders? Make sure that you've got good employment contracts, consultancy agreements, IP assignment agreements in place, because that is an area that investors always concentrate on and people can get caught out with. Just be aware and get that done. And then the warranties. So, a lot of early stage businesses and founders are asked to give warranties about the company. At the very early stage, there isn't much to warrant because business hasn't done much, but you will be required to warrant on the cap table and the shares, who owns them, and that they're all done correctly. At a very early stage, I'd recommend getting on just Inform Direct or any of the other platforms out there to make sure that your share issuances are done correctly. Cap table, you'll also be able to give a warrant on the business plan that it's been reasonably prepared, that all IP is in the company, and that all material contracts have been entered into on an arm's length basis. All pretty straightforward. So yeah, like in terms of warranties, there is a warranty, just by way of explanation, is just a statement about the company that both the company and the founders will make to the investors. If those warranties are found to be incorrect or untrue and damages are incurred by the investors, then you can be held personally liable. So it's important to read them, be aware of them, disclose against them, i.e. qualify those statements, so that the investors are making an investment decision with the full universe of knowledge when they are making those investments. These are always hotly negotiated, and you should definitely do it. Definitely concentrate on them. That being said, I was on the other side of a deal with a lawyer who, I think he'd been in the space for about 35 years. He was like, we're going back and forth, and with that, and he said, look, I've actually only ever seen one investor ever sue founders over breach of warranties. And it was a case of outright fraud. They just wanted to send a message to this guy that, he would properly rip them off. So once you're not doing that, you should be in pretty good shape. So don't rip people off, and you should be good on the warranties front. And that is everything from us. I think we can probably take some questions. Let's take a look through. Guys, in terms of questions, if anyone wants to unmute, they can put up their hands and ask a question. And I'm happy to either go through these or answer them by email as well. You can see my email address here, obviously on LinkedIn, and come reach out.
Hey, Bill, this is Amy. Thank you for this presentation.
No worries at all, Amy.
I had a question regarding, have you ever delivered this with an example of the money and the shares as a hypothetical scenario, and how the terms impact it real time? For example, $1 million angel round growing to a seed round, growing to a Series A, and maybe we're now negotiating at a 10 million Series A. And this is how these terms that you went so brilliantly through could impact that example of money in shares. Is that something that you've
When you
done?
say money in shares?
And
so what does that life cycle look like?
right. So for example, if we took the term, I have to go back in the deck a little bit, but if we took one of the legal terms that was, think about avoiding this term because it's going to negatively impact share disbursement at X moment in time. Have you ever done an example where, as you're talking through the terms, you're also demonstrating how that would impact the dollars and the shares of a hypothetical company, with X
okay.
number?
So I think we do that with the liquidation preference. Is that what you mean?
That would be a good example.
Yeah. So let me just have a look. Yeah. So I guess here's probably the best way of walking through it is effectively you've taken on £1 million of investment at a 4 million valuation. So founding team have been diluted by 20% there. So they're effectively giving away 20%. If they were to exit immediately at a 5 million valuation, then obviously they've, if you've got two other founders there, you're taking out 2 million each, plus the investor is taking out 1 million. Is that useful,
This,
or
yeah,
sorry, I don't
yeah.
know if I'm doing
This,
this right. Sorry,
no,
Amy.
no, Bill, it was great. This was really useful because just for me, I mean, I'm only speaking for this one single person, but this was really useful because this example aligned the money with it. And prior in the slide, there might be other opportunities where you could
Gotcha.
use the money example again, as it shows, you know, for some of us who are, we see numbers sometimes more than we see words, right?
Yeah, no, absolutely.
So repeating this in the deck, I think might be very helpful in
Okay,
certain
perfect.
slides where it's applicable.
Yeah, gotcha. We'll do that the next time.
Okay. So great stuff. Just quickly to jump in there and to say thank you, Bill, for a great presentation. And we're running a little bit over. But what I would say is, in terms of the questions, you know, we've had some brilliant feedback and comments, really useful, insightful, great presentation. There are some questions, I think, Bill, that might be worth looking at that have come up. Maybe if I just pick a selection of them that we can go through, and then the rest we can follow up individually. We have your names here, and we can post some of the answers in the mailing lists for those of you who need to leave now. We will follow up with the questions separately. One of the questions that came up was in terms of reverse vesting in the UK. How often is that used? Is that quite a common thing, Bill?
Yeah, practically. I don't think I've done a round with an institutional investor where that hasn't been included or negotiated for sure.
Right.
Yeah, like extremely common. You know, early stage with angel investors, oftentimes they're not as fussed about that, but as soon as you get an institutional check coming in, you know, one of the first questions will be around the vesting schedule and what the founders are committed to. You know, which makes a lot of sense if you're, you know, if you're taking on cash and you're saying we've got a 3 to 5 year business plan. Obviously, investors are going to be wanting to make sure that you're incentivized to stick around and execute against that plan. And also, if you know you need to step aside or leave the business, that there's sufficient equity to incentivize someone to come in and replace part of the founding team, if necessary. So yeah, for sure, reverse vesting extremely important.
And another question, this one from Rav Roberts. Can you confirm that EAS and SEA investors are not permitted to have preference shares? I think this was raised.
Yeah, that's correct. You know, anti-dilution or liquidation preference would disqualify relief.
Yeah. Another question here in relation to investors, the appointment of investors into an advisory board. I guess this is more of a complex question, but maybe you can give it a few points. You know, is this something that is recommended, or should it be avoided?
In terms of an advisory board, I'd start with, are they useful? You know, are they going to substantially add value to the business? Because you know, ultimately, if they are going to help you materially get from where you are to the next milestone and onwards and grow the company, that's great. Where it's a position, a kind of a hobby position, that's going to take up a lot of your time and bandwidth as a founder, I'd say don't bother. You know, fundamentally, it's your responsibility to drive the company forward. So you need to look at each individual who comes into the business, whether it be an advisory board position or an employee, and say, look, you know, are you driving this forward? If not, don't really want you involved.
I concur with that. I've seen it both ways. I've seen some startups who are very, very, very early stage with a really stacked advisory board, having given away already like 5 or 10% of their company to advisors, when frankly the stage they're at, they just don't need them. But on the other hand, if you get the right advisor who is willing to put his name to the company, support it, do introductions, then it can be completely game changing. That one person on the advisory board can really take you through from your seed up to Series A. So I echo that. It has to be, you have to do your due diligence, and they have to be adding value. And I think that's also important, that the agreement between you and the advisor is clear, that you know what they're going to bring to the table, and that you have some KPIs or something around it, so that they don't just talk a good game, but that something is at stake for them to actually perform with it. I think last question before we head off, and Daniel, if you could post Bill's LinkedIn into the chat, and mine as well. So if anyone wants to connect with either of us, please do. So this is from Amit at Football Fans. He wants to know, how do you work with startups? Is it fixed fee or what is it?
I'd say flexibly is probably the best description. Yeah, we try to do everything on fixed fee wherever possible. We think it leads to better outcomes on both sides. You know, from a company perspective, you know exactly what the fees are involved. We avoid awkward conversations around having to increase our fees. So yeah, fixed fee. And some of our clients on an ongoing basis then will come onto retainers, where we agree a fixed budget each month. They get access then to pro forma documents, obviously us at the end of the phone, and advice as well throughout. So yeah, fixed fee for the most part, and then retainers and our hourly rates as well are available. And just to benchmark, that would be $350 plus VAT an hour. It would be our hourly rates. So we are certainly not Clifford Chance, and you know, probably a half or a third what you get in a typical city law firm.
Yeah. Okay, great stuff. So I think we'll call it there. That's a really insightful presentation. Most appreciated. Thank you for everyone for attending. We will be following up with all of you with the materials and a recording of this, and also with Bill. Bill will be CC'd on the email. So if you have any questions for him, you can respond to him direct. And you know, as part of his workshop and his collaboration with EC, Bill and Seventh Eagle, you know, have agreed that they will they are happy to give a free consultation with anyone who has any preliminary questions. So please feel free to reach out to Bill as part of the communication. From our side, it's been a pleasure to host all of you guys, and hopefully we've added a bit of insight and value for you. You know, from our perspective, we're always looking for good quality founders to join our community. There was a free link posted by our chat earlier, which is to join our free community. So you're more, you know, please do register if you want to attend and hear about further workshops and things that we have going on in the community. Our commitment to you is that we want to put you in a better place as a startup than when we meet you. And you know, for us, we're always very happy to try and help you with what your pain points are. And we also commit that if you ever get to a point that you are not getting a benefit from the Entrepreneurs Collective, and you feel you got nothing out of it, we will happily return any fees you have paid if you're not getting value, because the last thing I want to do is to put you in a worse position and to damage your startup. But thanks to everyone again for attending. Thanks again to Bill, and hopefully we'll see you guys again soon.